So, welcome to season 2, episode 1 of Let's Talk Property. Rory and I pushed the keep calm and carry on mortgage button because the market's gone a little bit crazy with the war in Iran and all sorts. And so we thought providing a little bit of advice or information would be really helpful to people who are looking to buy at the moment, who have got a little bit spooked with the current market and mortgage rates. And so we've invited Tony from Capricorn to come along and give us some more information about the market. So welcome.
Thanks, guys.
Welcome back.
Thanks for having me back a second time. I feel very honoured to be the first guest of Series 2.
And our first second guest.
Wow.
In the first callback.
Yeah.
Record breaker.
Living the podcast dream. So a great place to start is what has happened in the market recently, because from January, February, it all seemed like it was going in the right direction. Interest rates were going to be coming down. People were ready to move. We saw many more people coming for mortgages. We've seen more properties coming on the market for sale. What has happened? If you could give us some help, that would be brilliant.
Yeah, it's definitely been a very fun time to be a broker over the last few months. To summarise, it's kind of a little bit of what we've seen really over the last 4 or 5 years or so in terms of changing climates and market volatility. It's nothing we haven't been through before, but to summarise, we started January with rates the lowest that they'd been in 2.5 years. That was sparing so many new buyers to come to the market, so many people to move homes. On top of that, we had all of these big affordability changes that happened last year as well. So you've got lenders willing to borrow more money. You've got rates coming down, which makes it kind of perfect market conditions in the industry. And I don't know about you guys, but it did start to feel like the market was shifting from a buyer's market to a seller's market as well.
Yeah. No, we were very active with our properties. We sold pretty much all of them.
Yeah. It's been phenomenally busy, hasn't it?
Yeah.
Over the last few months, definitely. And then unfortunately, Mr. Trump came along at the end of February. And yeah, on the back of the situation in the Middle East, we've obviously seen the price of a barrel of oil shoot up. All of the inflation data and inflation forecasts that the lenders were using to price their products, and also Bank of England base rate reduction forecasts as well. They all changed, and on the back of that, lenders have had to increase their rates. So from beginning of March to end of March, we have seen rates jump up quite significantly, in a lot of cases on average by around 0.75 to 1%.
Yeah, that's quite a significant jump really, isn't it?
Yeah, that rates are basically at the same kind of level more or less than they were in 2024. So it just goes to show in this kind of market, in this climate, how quickly things can change.
Yeah, no, absolutely. Are lenders still happy to lend more, or are you seeing that drop alongside this, or is it too early to say?
A little bit early to say. I mean, right now the same income multiples still apply, so you still have the lenders offering five times, 5.5 times, 6 times or more. What has actually started to change with a few lenders? So I think I mentioned this last time I was on as well. When a lender tests your affordability for a mortgage, they're not testing your affordability based on the rate that you're securing. They're testing your affordability on a higher rate. It's called the stress test rate.
Yeah.
And with all of their rates increasing, a few lenders have also had to start to increase their stress test rates as well, meaning that for some people, the maximum loan amount available to them might be a little bit different than last month. Not a huge amount. We're talking about small changes, but that's what we're starting to see anyway.
Okay. And if you already had a mortgage agreed in principle, how could this current market situation change your mortgage rate or current situation?
So it's a bit of a common misconception that you secure or reserve a rate when you get pre-approved for a mortgage. And by pre-approval, I'm talking about agreement in principle, decision in principle, pre-approval. They're all the same thing. When you get an agreement in principle from a bank, all it is a credit check confirming, yeah, we've done some background checks. When you find the property, we can lend you a maximum of X amount. There are only a couple of lenders across the whole market that actually allow you to reserve a deal for a certain amount of time at mortgage agreement in principle stage. So for most people and most lenders, you've been pre-approved for a mortgage, but you haven't actually reserved the deal. So the rates are going to be different to when you got pre-approved.
Sorry, go ahead.
So if you just an example, if you have, if you've got an offer accepted on a property end of January, for instance, everything's gone through, all paperwork's going through, mortgage surveys being done or has been done currently, depending on time frames. They're agreed. That rate is
So they're all fine. You don't need to worry if you've got an application progressing. It's another common misconception, and when we see rates increasing, I get lots and lots of the same questions from clients about hearing that lenders are withdrawing products and pulling products, and are their mortgages safe? When we submit a mortgage application, the mortgage deal is reserved. That's what I say to clients. As soon as you have an offer accepted, the priority is let's get the application submitted. So when it's submitted, the lender are going to give us lots of time to actually progress the case to full mortgage offer. One thing I will say, and one thing we have noticed over the last few weeks, because lenders are so busy right now, and also because you've reserved a rate that they're no longer offering anymore, they're being less and less patient around how long it takes you to get that case approved, how long it takes you to send the documents across. Sometimes if you don't get everything across to them within a certain amount of time, they are more prone to cancel the application and say, come back to us when you've got all the documents. So it's also really important in terms of preparation for an application. Make sure that if when you're kind of speaking to your broker, if they request some documents from you, get everything across to them right away, because you wouldn't want to get the application submitted and get the deal reserved, and later on down the line, the bank cancels the application because you didn't give them all of the documents quickly enough.
What sort of documents out of interest? Can people have them ready Because I'm just thinking from our perspective on viewings, you chat to people and everyone's in a different position.
Yeah.
And obviously everyone thinks they have something in place.
Yeah.
I mean, you don't know what you don't know, right? And when it comes to mortgages and current market changes, like how much of all the documents can be prepared before the deal's gone through, and you just don't know this. So that would actually be really helpful. I assume it's like bank statements, passport.
Most of the documents can be prepared really easily. ID documents, bank statements, pay slips if you're employed, deposit proof, that kind of thing. If you're self-employed, we need like tax returns or maybe limited company accounts. Most of those documents are quite easy to put together and we can have them on file. If you send them across and the pay slips are a little bit out of date, it's fine. All it means you need to do is send across a couple of extra pay slips or bank statements. That's what I'd say is really, really important to do to get prepared, because it might be the difference between securing a good deal or missing out.
Yeah, so get organized, get prepared, move quick, don't hang around, or you can end up spending a lot more money unnecessarily, effectively.
100%.
Okay.
I was going to say as well, I also think it's important, given that things have changed quite quickly in a short space of time, if you haven't actually had a look at options even within the last 2 or 3 weeks, get a refreshed update on what that mortgage looks like today versus 2-3 weeks ago. Check that the monthly repayments are still within your comfort zone. If they're not within your comfort zone, an experienced broker is going to say to you, have you thought about this? This is one thing that we can do to keep your payments manageable and keep them within your budget. That's why in these kinds of markets, in this kind of climate, you're really going to see value from an experienced broker helping you versus trying to do it yourself.
Okay, fine. And in what? Sorry, Frankie's rolling around your feet there. He's going to jump up. Camera can't see
us all.
But Frankie's trying to make himself a comfortable bed on the floor, but actually just has to be a dog on the floor. Frankie, lie down. Go on. So you said about speaking to your broker about trying to make those monthly payments more manageable.
Yeah.
What would that look like? What are the options that you have available?
So let's say we look at mortgage term. So a lot of people think that the average or standard mortgage term is 25 years. There isn't really an average or a standard mortgage term. I think part of the reason why people think that is when you go online and you see these mortgage calculators built into Rightmove, it's just preset to 25 years and we'll have like a stock rate of interest in there. So depending on your budget, you can look at any mortgage term up to 35 years or even 40 years with some lenders. So let's say you were looking to borrow £500,000 and the mortgage payments at the start of the month were looking like they were going to be £2,200 a month, and now they're going to be looking like £2,500 a month. One of the things that we can do is just extend that mortgage term, make it a little bit longer. We have to add 5 years onto the mortgage term to make that more manageable. That's something we can do. And the thing is, because I have these conversations a lot, some people might think, oh God, it was already a 35-year mortgage term. 40 years sounds really scary. It's not a 35 or a 40-year commitment. If you're looking at a 2-year fixed deal, it's a 2-year commitment. In 2 years' time, when it comes to remortgaging, we're going to negotiate a brand new mortgage, and we get to look at rates again, and we get to look at your situation again. And as long as it's within your budget, there's nothing stopping us from taking that 35-year remaining mortgage term and reducing it all the way down to 25 years.
I think that's a really interesting point because, people are ready to move in London. After we all waited for the autumn budget that came in, the market was absolutely dead. People were not willing to take that risk. They didn't know what they were buying. They didn't know if there was going to be a big tax lump on their property. London reaches this boiling point when no one's moved for 6 months or 8 months. Everybody then wants to move. And that's what we kind of saw in January. And that's what we've experienced. And then, of course, it's such a shame that we've seen this, the interest rates go back up again and therefore the mortgage rates. And I think it's interesting to look at it. Okay, well, 2 years is probably a decent amount of time. We can all but hope the war's over by then and interest rates start to come down. So in this period of time, if you still wanted to move, but you were just going to be too stretched because, the inflation affects everything, not just your mortgage, by extending that rate, it can bring down your payments and make it a bit, which I think that's a really great piece of advice, really.
It's just a short-term measure. We need to look at things that we can do to get people moving, get people on the ladder, make sure payments are comfortable in the short term, and then we can renegotiate later on down the line.
Absolutely. And then speaking of, 2 years fixed term tracker, is it worth at the moment? I mean, obviously it's very personal and people need to choose based on their own situation, but what would the advantages and disadvantages be of going on a fixed term at the moment based on the slight volatility in the market versus
a tracker deal?
The tracker deal.
Yeah. So this is a conversation that I'm having a lot more frequently now in the last few weeks. We tend to see, because if you think about a few things that have happened over the years that have impacted rates in the market, COVID, the Truss Kwarteng budget, Ukraine war, now Iran war, whenever we've seen fixed rates like jump, tracker deals have become more attractive just because they're priced differently. And just to remind you of what I mean by a tracker deal, instead of agreeing to a fixed rate, what you're agreeing to is a fixed margin above Bank of England base rate. So just to give you an example, if the base rate today is 3.75%, and you're agreeing to a margin for the next 2 years of 0.5% above the Bank of England base rate, that gives you an effective rate of 4.25%. What that means is if the base rate changes, your effective rate of interest changes by the same amount. So if the base rate reduces by 0.25%, your rate does. But if the base rate increases, it also means your rate increases as well.
It goes, sure, people, because everyone sort of generally, it's perceived everyone will go fixed rate generally you probably give me a different stat, but if it's variable, when does it, so if there's a change, how quickly does that change affect your payment?
Yeah. So your very next mortgage payments will factor in that increased rate of interest. Part of it's kind of a more risk, more reward, because the risk is that things might not go the way we expect and rates could increase and your mortgage payments could become more expensive. The reward is that tracker deals, and most tracker deals, and certainly the ones that kind of I'm looking at right now, don't have any early repayment charges. So with a fixed rate of interest, you're locked into that deal for that 2 or 5 year period. And if you want to exit that deal early, what I mean by exit early, if you want to sell the property or if you want to renegotiate the mortgage and get a better rate, you have to pay that penalty to exit the deal early. With a tracker deal, because there are no penalties, it means that later on down the line, if rates did reduce, you can switch to a fixed deal whenever you want without any kind of penalty. And that's part of the risk and reward.
Yeah.
And then the other kind of benefit right now, the reason why tracker deals are looking more attractive is on average, they're probably priced about 0.5% lower than fixed rates right now.
Are you seeing more people taking the tracker rates than the fixed rates at the moment or not?
I'm still seeing more people take fixed over tracker, but I'm seeing a lot more people go for trackers now than a few months back, definitely.
That's really interesting because I would think many more people would be going for fixed because this is volatile, seeing what's happening in the Middle East, et cetera, et cetera. And I think people I mean, I'm making a complete assumption here based on my own views and also my own perspective, is I think that fixed security, knowing that it's not going to shoot up, is almost worth paying a little bit more for at this point than having that risk of it suddenly going up to 6 or 7 or however, much. So I'm quite surprised that more people are kind of going for the tracker, but maybe they just also just feel they don't really have the option and they need to kind of save what they can on a monthly basis and we'll take it from there.
I think it's because, like I mentioned about some of the big events that have happened over the last 5-6 years, people have seen this before. They've been through it before. They've watched rates increase and then reduce and things recover and get back to normal again. One of the things I will say is it does massively depend on risk appetite. And if you're a first-time buyer, you're a single borrower, you don't have to worry about kids and school fees and childcare fees and everything else, then your risk appetite is going to be a little bit greater than someone who's upsizing, taking out a 7-figure mortgage, does have all of these fees to think about. They're less likely to go for a tracker deal. So a lot of it just depends on how much risk do you want to take on?
Yeah, risk and circumstances.
How brave do you feel?
Yeah. I mean, we've all been through enough over the last however many years. So I think we've all got a bit of a tolerance to risk and change, I suppose.
I'm actually on a tracker deal right now.
Are you?
Yeah.
We just did a fixed, actually.
Did you? You didn't speak to me about him. Put you out there.
So, what do you think about that?
Well, I'm just like, I just think, yeah, for me, it's that risk tolerance. And we've got kids and expenses and inflation bites.
Yeah.
And I just want to make sure I know. And it's 2 years because I'm hoping within 2 years things will be settling and going in the right direction. And I don't want to say feel confident that's going to happen, but I can't imagine it's going to keep getting worse over the next 2 years. I think they will reach a point in terms of just the economy and looking after every Western economy that, we don't go into a complete recession and meltdown, right? That doesn't help anybody. So, I mean, that's certainly not an objective of the war. So I would hope, which actually is probably a good reason why a tracker would be a good option to go for. Just put myself out of this position.
Sounds like you're arguing with yourself.
I did. I just proved myself wrong. That's so me.
But what you've just told me about your preferences and your plans and why you went with a fix, that's exactly what I was talking about. There isn't really a right or wrong answer. That's exactly why, you need to sit down with someone and they properly understand your situation and what you're looking to achieve and your risks and everything else that you're looking at. In my case, the main reasons why I looked at a tracker at the time, well, number one was virtually no difference between a fixed and a tracker deal. And I was happy to take on a bit more risk. But number two, I am planning to sell that property and upsize in the short term. And even though rates have increased, I still need to upsize. I still need to get a bigger place. I still want to buy a house with my girlfriend. So we absolutely, touch wood, are still going to do it later on in the year still.
Yeah, absolutely. And that early repayment charge is going to wipe out any savings or whatever anyway. So
exactly,
that will make sense. That makes sense.
You made a good choice then. Well,
thank you.
Yeah.
It's almost like it should be a mortgage advisor.
You took the words right out of my mouth.
What are you guys seeing right now in the market, by the way?
So it's interesting because
I think it's been great.
We had a great start to the year, and you think it's going to get potentially quieter, but we've just today launched another property. We did a couple of viewings today on a property that's offered in excess of 1.75 million.
Nice.
Which we launched last week. We're right in the middle of everything's happening, and most of those buyers are keen to still move.
Yep.
And as they realize it's still a good time. If a property's priced right, there's still inquiries for it.
Yeah. You want to buy in a buyer's market, don't you?
Yeah.
Yeah, I think so. I think, as I said, London reaches a boiling point where people need to move. And there's a point where they won't move because there's too much risk and too much uncertainty, which we've had thanks to the autumn budget and a bit of in a tough few years. London's had, it has its fair share of challenges. And I think people want to move, they're ready to move, but they're very price sensitive. So you've got to price a property right, you've got to present it well, and it will go. But if you don't price it right and you don't present it well, it will sit on the market for a long time.
Yep.
So generally that's what we're seeing, that's what we're seeing out there, really.
And the conversations with everybody, most, people are, as I said, with like an example of a property that we, in an area where all the properties were a certain price and we had a brand new strategy for it. effectively the area, I won't give too much, kicked off about the price point. We've secured a very good price for the owner with the strategy from a very good buyer who wouldn't have looked at it otherwise. And there's other properties that were on the market before we came to market, haven't changed their price, are still on the market,
Yeah.
and they've missed out on the buyers. And the people that work in the area told us that we got the most viewings through there in that period because they could see everybody coming and going. And that's just, it's an example again of, effective risk and reward that we've talked about the other side.
Yeah.
The seller wants to get rid of their property. They want to move. They want to take the money out. So we did the risk and reward, and it's paid off.
Yep. That's the thing. London's one of the strongest property markets in the whole world, isn't it?
Yeah.
On my side, it's all about the repayments. If the repayments work and it makes sense, and your mortgage payments are going to be round about the same level as how much you're paying in rent, maybe a little bit higher, in some cases actually less, then it totally makes sense to buy now still, especially while it's a buyer's market. Don't wait for the market to shift.
Absolutely. There could just be another reason that, can make it challenging, but just coming from a different direction. So let's keep moving. That's what I like to say. Speaking of which, so in terms of mortgage applications coming into you at the moment, is there a particular sort of buyer group? Is it first-time buyers are coming to you at the moment? Because one of the things that we've seen are, quite a lot of landlords are offloading their properties thanks to the Renters' Rights Bill that's been coming in. So we do think, certainly in parts of London, I've seen it in Parsons Green, in Fulham, there's more stock on the market. So are you seeing more first-time buyers who are wanting to take properties at the moment, who are applying for mortgages? Is it families? Is it 3 million plus market? Is the 5+ market dead at the moment? Like, what are you seeing in terms of who's buying and applying for mortgages?
So I haven't seen much change on that side of things since the start of the year. What you tend to notice is when rates are really low, people aren't afraid to borrow more and take out bigger mortgages and put down a lower level of deposit, and put that money to one side for home improvements, works, loft extension, something else. What I've seen since the start of the month is people being a bit more hesitant to absolutely max out on the mortgage debt. It's one thing telling someone that they can borrow 5.5 or 6 times their annual income, but when they look at the repayments, they're actually keeping the surge parameters just a little bit more conservative. So that's what I mean about them being so sensitive when it comes to monthly repayments. So still the same amount of first-time buyers, still the same amount of home movers. The conversation I'm having now might be, I was looking at a property at 800,000, but based on where the repayments are right now, I'm probably going to stick to a purchase price of 750,000.
Okay. All right.
Do they come to you and say that, or do they ask?
It's a bit of both, really, because I want to give someone in my case, I want to give someone a really clear picture of what's possible. So I always ask about the monthly repayments.
Yeah.
And if we're comparing from then to now, it's very much okay. Then we're looking at mortgages today. What kind of purchase price would I need to target to get my repayments no higher than £3,000 a month?
Yeah.
And it might be the case that we do a like for like comparable, and then they decide to kind of look at a slightly lower price point. Or there are quirkier things that we can do with the mortgage, like I've mentioned about extending the mortgage term. We haven't spoken today anyway about like interest-only mortgages or part interest-only mortgages. That's another way that someone can still target the same purchase price that they could last month and keep the monthly repayments around about the same level as well. So it might be the case that we do stick to the same kind of purchase price, but we think a little bit outside the box about how we structure the mortgage.
Yeah.
Interesting. Do you have anything else that we want to cover? I think we've kind of covered the keep calm and carry on. Let's not freak out about mortgages moment.
No, I think we covered. I think it's What was the question I asked?
I think you asked the question about should people worry if the mortgage is offered and rates have changed?
Yeah. So if someone's offering a property, I think you were saying you've had the busiest March. I know we're just into April, but busiest March you've seen ever.
Yeah, 100%.
And that because people have had offers accepted on properties, and they're trying and you pushing everything through. It's quicker on. I know you said about earlier. We said about everyone having to get the documents to you. Is everyone realize when you've told them now, look, you need to get it to me now because something could change tomorrow?
It's actually a lot of the work and a lot of the effort that we've seen from January onwards, because you know that at the start of the year, people tend to start their searches. And if you think about If you think about how many new people were coming to the market, how many viewings were taking place,
Yeah.
how busy it was, with a lot of those people, it's only in February and March that they actually have their offers accepted. And then obviously rates started increasing at the beginning of March. Lenders also give very, very short notice as well of rate changes. So I think last year, over I think I read a stat somewhere between 80 and 90% of all of the mortgages across the UK were submitted through mortgage brokers.
Okay.
So
Oh,
so the banks, because they rely on us for business, they have to give us advance notice of when they're gonna change rates. Used to be the case that they used to be really nice to us and they used to give us 2-3 days notice. In a lot of cases now, it's a few hours notice.
oh,
So they might email us in the afternoon to say, right, we're changing rates tomorrow. You've got until 8 p.m. tonight to get the application submitted.
no way.
Yeah. And then we have to literally clear our diaries, give our clients a call. Right, you need to get these pay slips and bank statements over to me today. I have to submit the application today. And then within that couple of days window, the bank who's increasing their rates sees 4 or 5 times the amount of applications they normally would. Very chaotic on the bank side and on our side, actually, to get everything in and submitted in time. And then that has a knock-on effect on like service levels and turnaround times.
Yeah.
Totally, yeah.
Banks then take a lot longer to assess applications. There's one big high street bank right now, and I won't name them, but they're taking up to 15 working days just to pick up and take a look at an application that you've submitted.
Wow.
Yeah. So that's an example of how the rate changes impact the whole journey and how long it takes to actually get a mortgage approved.
Does that bank have one of the lowest rates then at the moment? Like, are they just offering one of the best rates, or is it all kind of same to same, really?
It's all pretty similar, but what happens is, let's say one lender is offering a market leading deal and then they increase their rates. Lender number 2 then becomes lender number 1. And then they get flooded with new applications. And after a
Yeah.
few days, they get too busy. And then they say, oh, we need to increase our rates now. And then lender number 3 becomes lender number 1.
Oh, wow.
And that's what happens. So a lot of the price changes are also determined by how busy the lenders are and service levels. I've had a couple of lenders come into our office and say, yeah, we've had to increase rates just because of how busy we are. Give us a couple of weeks to get our backlog sorted. And then if we can, we might actually look to potentially reduce rates. Not by a huge amount, but
Well, so I imagine when that call comes in from the bank, it's like, everybody stop what you're doing. Call every client you have and get it locked in now.
literally, yeah, it's quite chaotic.
Yeah. Feels like Wolf of Wall Street vibes.
No, it's definitely been
Get it locked in.
it's been a fun month, and obviously we're recording this just before the Easter weekend. I'm very much looking forward to a 4-day weekend.
Good. Well, I'm sure it's well deserved.
Yeah, and you guys as well.
Yeah, we are. We're ready. We're ready for a bit of a break.
Yeah.
Well, that has been really insightful, really, really insightful. And I think there's just so much going on. And let's be honest, there has been so much going on from all angles over the last however many months, really. And I think just providing a bit of clarity on the mortgage market in London, or really in the UK at the moment, has been extremely helpful. Also, as us as agents, to make sure we're asking buyers the right questions when they're coming to have a look at properties and make sure they're as prepared as they can be. And also for our sellers who maybe are moving on and looking to buy something else. So, Tony, thank you.
Pleasure.
Yeah,
Thanks for having me back on anytime.
Amazing. So, yeah, thank you so much.
Thanks, guys.